Real estate has the disadvantage to common stocks of being illiquid. But then along came REITs, real estate investment trusts, that created liquidity for real estate products. REITs, or real estate investment trusts, are companies that own or finance income-producing real estate across a range of property sectors. One of the highest quality, most popular REITs on the planet is Realty Income. But as you can see, Realty Income is really attractively valued at this multiple of 15 times operating cash flow, or what's known in the REIT industry as funds from operations. The best time to invest in this REIT would be when its price was touching this orange line. As you can see, even though this is one of the highest quality REITs on the planet, it's slightly overvalued today. With this video, I'm going to be looking at real estate investments that are attractive, and unfortunately, they're few and far between. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And this will be number 10 in the series of the Investor Tuesday request series that I've been doing on the various sectors. There are 11 sectors, and this will be the 10th and next to the last sector that I'll be covering here. Unfortunately, as I screened for good investments in the real estate industry, I was really able to come up with only 7 names. Now, what I want to show you is that 5 of those names are REITs, or real estate investment trusts, and the other 2 are diversified real estate companies that are engaged in diversified real estate activities. So these are the 7 companies I'm going to be looking at. As I have done with all of these videos, this is a very high-level video. Okay, I'm not going to get deep into research on any of these. I'm simply going to give you an assessment of the liquidity and the value that this particular sector offers. Most REITs today, in my opinion, are overvalued, as I illustrated with Realty Income in the beginning of this video. I also want to point out that we're dealing with a very expensive stock market here that's beginning to show signs of correcting. It's at least very vulnerable to a correction to come back down to its intrinsic valuation, which is the orange line in this graph, or even its fair market value or average market value line, which is the blue line. You can see the markets are very vulnerable, and with interest rates going up, that could have serious effects on not only stocks in general, but REITs as well, because obviously real estate is financed with that. So I'm going to go over these very, very quickly here. I'm going to go through these companies and show you the various REITs that I have found through my screen here. And I'm going to start with Highwoods Properties. Instead of earnings here with REITs, I'm typically going to be using funds from operations or adjusted funds from operations. And I want to point out, the investment merits of REITs, which are generally good income vehicles. As you can see, Highwoods Properties here is a BBB rated REIT. The company offers a 4.76% dividend yield. One thing about this REIT, it doesn't grow very fast. The average growth has been 2.64%, but right now you can buy it with a slight margin of safety and an attractive valuation. So if you were looking forward on this REIT, it is capable of generating very substantial rates of return if the REIT reverts back to its normal, 15 times operating cash flow. But I do want to point something out. This orange line on this graph is only using, because of the low growth rate, a 13.78 funds from operations multiple. So we'll round that up to 14. And so when I'm looking at this graph, I want to look at, something between 13 and 15, which would put that REIT about right here. But that would, on the second line below the dark orange line, which means I still have very substantial opportunity here with very good income on Highwoods Properties Trust. It's a very good REIT that's attractively valued today, and one of very few that are. The next one I want to look at is Mitsubishi Estate Limited. It is not a REIT. It's a company engaged in diversified real estate activities. This one was actually more interesting to look at from a standpoint of operating earnings, because it's not a REIT, so funds from operations don't matter. But what I really wanted to point out, the reason I liked this is it screened. It did meet my screens of having earnings yield or FFO yield over 6%, and it's an A+ rated company. But notice the effective valuation here, how this stock was so highly overvalued back in 2013 and 14. It has a March fiscal year. And look how the stock has just slowly but surely, moved back into alignment with fair value over all these years. That the company did extremely well. They had good growth, double-digit growth in many of those years. and they had good dividend growth in many of those years. But the problem is valuation kept this from being an attractive investment, and it's now come into fair value territory. It offers a 1.37% dividend yield, and again, it's not a REIT. It's one of the two that is not a REIT. The next company I want to show is National Retail Partners. Once again, you see the fact that the company grows about 3.5 or 4%. You can see the effects of overvaluation. Of course, it was vulnerable when COVID hit, but it did recover dramatically. It's trading right now at a normal multiple. Forecast growth is low to be about 2.5 or 3%, but it does offer a 5% dividend yield. So this one does offer the potential, to generate potential rates of return if you're looking at long-term growth here of maybe a double-digit rates of return, and it does offer a 5% dividend yield. I don't think this one does have the margin of safety that I would like to see. It would have been more attractive buying it coming out of COVID, but at least it's one of the few REITs that are attractively valued. Omega Healthcare, I'm going to move this to AFFO, or adjusted funds from operations, and look at it from a standpoint of valuation. The stock offers a 9.4% dividend yield. It has an AFFO yield of over 11%. The company is BBB- rated. It's been growing at over 5% a year. It's forecast to continue growing at about 1 or 2%. Long-term growth rate is still in that 1 to 2% range. But the real allure here, the investment merit here, comes from the fact that it's discounted in valuation, and it offers an extremely high yield. So Omega would be attractive to people looking for current income and capital appreciation based on a reversion, to mean valuation. And this would be true even, by the way, if you're looking at the normal multiple, which is lower. This would still give you double-digit rate of return potential. Buying Omega down here with almost approaching a 10% yield, 9.5% yield, if you will. So that's Omega Healthcare Ventures. The next one I want to show is this SL Green Realty Corporation. It's office REITs. From a standpoint of AFFO, it doesn't look quite that attractive. From a standpoint of FFO, it does look more attractive, but the stock, again, was trading at a very big discount about a year ago. Notice the cyclical nature, so that could explain why this REIT is trading at a reasonable valuation compared to the others. From a forecasting point of view, it is expected to grow a little faster than the others I've showed you, both short-term and long-term, 5 or 6%. So this one could be very attractive now with a 4.72% dividend yield. The company's BBB- rated. This could be a good one to going forward, but note the cyclicality of its historical results. That's something to at least be aware of. Simon Property Group, which is a mall REIT, one of the higher quality ones out there. It did struggle with COVID. Of course, that was not really due to management missteps as much as it was the pandemic. You can see where the stock collapsed, but it's recovered beautifully. They did reduce their dividend, but their dividends began to grow again. You can buy this with a 4.72% dividend yield, 8.55 FFO. It might be worth taking a closer look at Simon Property Group. Anyway, that is what I see available at reasonable valuations in the real estate space. There's a lot of really high quality REITs out there. I'll go back to what I showed you with Realty Income. This is one of the better REITs. They call this the monthly income company. It's one of the highest rated, highest credit rating of all REITs. The only thing I don't like is the valuation right now. I want to be buying this when I can get it. If I'm patient, I can wait and get this REIT at an attractive valuation. I love the business. I don't like the valuation. That's the key. Anyway, this has been Chuck Carnival saying thanks for watching. Hope you enjoyed this on REITs. This is number 10 out of 11 subscriber requests to look at value in all the various sectors. Next week, I'll be covering utilities, and that'll be the final in this series. I appreciate you tuning into these videos. If you liked it, give me a like, ring the bell. And, of course, if you haven't already, tune in or subscribe to the channel so you can get access to more videos. After I finish this series, my next video is going to be on identifying attractively valued, good quality dividend growth stocks for those investors who are looking for current income. Anyway, this has been Chuck Carnival saying thanks for watching.